FAANG stocks soaring back from the lows that they made just back in April, and many of these stocks are now up on the year. We had earnings this week from Meta, from Apple, from Amazon, and Microsoft. The AI and data center trade is back on and is going full steam ahead. I'll outline that and why on today's video. We had a critical ruling in an Apple case that is not only going to affect Apple, but anybody that sells on their app store. We have news from Google in the courtroom, and can Tesla rebuild its brand? We'll discuss that and more on today's show. What is going on, investors? Hopefully you guys are doing well out there. It's been an up and down start of the year, but we are back up and stocks are moving way higher, including the company that we always kick things off with, Meta Platforms. Start of the week at 549, blasted up 8.6%. Finished the week close to 597. Year to date, shares of Meta now up 2%. If you bought the dip, pat yourself on the back. That's after the company announced their earnings this week. Revenue ahead of expectations, coming in 16% higher over the previous year to $42.3 billion. The big news out of Meta this week was the fact that they bumped up their CapEx range. Now, the difference between Meta's CapEx spend versus a Amazon, Microsoft, and a Google is, as you know, those companies spend money on CapEx. They use some of that internally to run Amazon.com or the Google search engine, but then they lease it out to startups and large companies and enterprises. And so they actually gain revenue from that CapEx spend. Meta is a little bit different. They don't actually have that revenue model. They're actually banking that this AI and this CapEx spend actually has a big return in the future. It's a risky strategy over at Meta, and will it pay off? They released a standalone AI app this week to compete with ChatGPT, Grok, Gemini, and others on the App Store. They're also developing those large language models that they release out into the public for free via open source. So much of this CapEx is spent on data centers that then train large language models that anybody can use. It's a risky strategy as Meta is trying to become potentially maybe the Android of the large language model. It's going to be hard to pull off. But obviously the company has internal uses on obviously across their social media platforms for AI, and to layer that on without having to rely on OpenAI or Google or Microsoft or any of these other companies. So it's likely a strategy that will have some benefit, but their CapEx spend is different from the rest. Speaking of being different from the rest, and that is Equity Empire. Earnings season is floating right along, and we did not waste any time in April. I believe off the top of my head, issuing 15 buy alerts as the markets were tanking, institutional investors were selling, everybody was panicking in my comment sections and my DMs, and we were steadily recommending stocks. You can probably imagine how those have worked out, including a small cap stock, which I believe is up 20% since we recommended. That's what you get over at Equity Empire, a steady hand in markets that are unsteady. Moving on to Apple, start of the week at 209. This company have an amazing amount of issues that they're having to deal with over the next couple of months. We'll discuss those as shares drifted lower by 2% on the week to finish the week at 205. Year to date, shares of Apple still under pressure, down 18%. The company announced their earnings. Revenue was good. It beat expectations, up 6% year over year. iPhone sales, including in the region of China, were actually ahead of expectations for the most part. Services revenue coming under pressure just a little bit. We'll get to that in a minute, but overall the earnings in the most recent quarter were not bad. The company also boosted their dividend by 4% and announced a $100 billion buyback, but that buyback was actually lower than the previous one that they announced last year. The big news of the week came when a landmark ruling calling for reforms to the App Store that doesn't allow Apple to collect that, quote, Apple tax on every transaction that throws through the App Store. So those 30% that the company earns on every dollar that flows through the App Store, well, that potentially is going away, including Spotify, which following this latest ruling released and improved a new application that is now live in the App Store that allows you to pay for your subscription at Spotify in a different way. And in some cases, it's actually a lower cost because now they're not realizing a 30% tax to the Apple Store. This is an example of the failures of Tim Cook. When this story started percolating several years ago, and we've outlined basically every step of this case here on the Investor Channel, channel. Apple should have went to the game makers and the others and worked this out on the side. If it was just Epic Games that had a problem, you could have worked out a sweetheart deal with them under the table quietly, and then nobody else would have had to know, and this gravy train could have continued. But you let it fester. You let it get into the court. You let a judge start to decide, and that is when things go awry. Now, Apple's number one profitable from a gross margin perspective business is under pressure. In fact, it looks like it might be going away, and so the company is going to have to make massive adjustments, and so the stock is selling off, not just on the fears about China and tariffs and trade. It's actually this. These are 30% margins or 30% take rates on every dollar that flows through the App Store. And if that goes away, well, we're talking about tens and tens of billions of dollars, and Apple is going to have to adjust. And I just think this is a failure of leadership to allow this to get to a courtroom. That was the biggest mistake by Apple. And this will also carry over to Google, because as this ruling will imply, this will likely apply to Google in future rulings, and both companies will not be able to accept and collect those lucrative app stores. Now, obviously, Apple is going to try to appeal this, but they are running out of legal options, and most legal opinion believes that Apple's pretty much screwed. Now, speaking of Google and Apple potentially working together to reach a Gemini AI agreement, that's according to Sundar Pichai, as that Gemini service, that AI application, could come to the iPhone. This is another failure by Tim Cook, is he's basically let the AI race get way past him. He doesn't have real significant working AI on the phones, and he's having to work with OpenAI. He's having to cut deals with Gemini, and it's just simply not working. Now, moving on to Amazon. What's up, buddy? How's it going? Amazon started the week at 189, drifted lower on earnings, and then bang, butted its head back onto 189. You're going to see this one technically as well. That 190 level is critical with Amazon, and I'm going to be watching it very closely if it's going to break down from there or break higher. There's probably some trade setups and some investing opportunities there. The company announced their earnings yesterday, revenue coming in at $155 billion. That was nearly 9% growth. It was a beat expectations. The second quarter guidance was good enough considering the circumstances with the tariffs and the Chinese sellers and all those types of things. Now, Amazon is in talks, or was talking up its AI potential on its earnings call. In fact, they are saying that it's growing at triple digits, and if they had more compute power and more GPUs, they'd be able to have more customers, because the same thing is true over at Amazon, or excuse me, the same is true over at Microsoft and Google and pretty much every cloud provider. They have more customers for AI, more people needing access to these GPUs than there are GPUs available. In fact, when we get to Microsoft, they thought they would be at full capacity or be able to meet demand. That demand is still exceeding their ability to supply. This is super bullish, incredibly bullish for all the cloud providers out there. Even more bullish for the semiconductor industries, particularly the ones at the forefront of the AI race, including Nvidia, which we'll talk about here in a minute. The de minimis exemption, say that a few times fast on a Friday. This exemption was for items and shipments worth $800 or less coming in from China. They were avoiding these 145% tariffs. Now you are going to have to pay 145% tariff on any goods virtually coming from China that don't have a separate exemption. So anything, any shipment, any package under $800 declared value is going to have 145% tariff slapped on it. So you can imagine this is impacting the Temus, the Chinese direct sellers, anybody that is trying to sell. Amazon brought up on their conference call, and it was a very unique point, that they actually might be better positioned to capitalize on this, as you have e-commerce sites and other platforms out there that might not be able to deal with this. Amazon has such broad amount of inventory, broad amount of sellers coming from all different types of regions, that they might be able to skirt around and not have, quote, empty shelves like some retailers might have. We'll certainly see how this plays out. It appears to be some softening of the rhetoric between both China and Trump over the past just 24 to 48 hours as it relates to trade and negotiations between the two countries. I think it's going to play out over several weeks, but if things keep progressing like it is, probably will diminish over the next several weeks. Amazon talked up that they're expanding their delivery network, including creating a lot of efficiencies to lower costs. They're also investing to deliver for people that live in small or rural towns, potentially expanding the market there. Moving on to Netflix for the week at $1,100. This stock hasn't gone down in, I think, forever. It was up 5.5% this week to finish the week at $11.56. Not a lot of news, though, out of Netflix. Moving on to Nvidia, started the week at 108. Boom, up 5.6% before the company even announced earnings. We didn't even really get a lot of semiconductor earnings this week, but the positive news from Meta and Microsoft and Google certainly soaring this one higher. Still, year to date, though, Nvidia down 15%. Jensen Huang was at the White House this week at a White House event talking up his $500 billion plan to manufacture and develop more chips here in the United States. It's interesting as Jensen Huang is cozying up to the president. This is what a CEO should be doing, folks. I don't know how Jensen Huang votes. I don't know how he stands politically, socially, or all those types of things, but he is doing what's in the best interest of Nvidia. He's dealing with the fact that his product is at the center of trade negotiation and sanctions and bans and all these types of restrictions. So he's trying to get and weave his way into the White House so he can get his sales up even further at Nvidia. This is what you pay these guys the big bucks for, and this is why he's one of the best in the business. I believe he's getting the Trump administration to work on changes to the AI diffusion rule, which would put several more countries in the restriction list as it relates to getting these GPUs. He's also calling for changes to rules regarding chip exports. You can imagine when he's sitting down with the president, he's probably bringing that up. And this was the big headline of the week, the fact that there's a rumor that Nvidia is actually resuming developing China-specific chips following an export ban. You might recall just a week or so ago, the Trump administration essentially banned the H20, which was a Chinese-made specific chip made by Nvidia that was shipped into that market. And Nvidia had to take a $5.5 billion charge that they'll realize on their next earnings because that chip is now banned from an export perspective. The fact that they cozied up to Trump at the White House, and now the rumor is they're working on a new China-specific chip, probably tells you that those discussions with the president probably went pretty well. Now, not going well is Supermicro as shares sank 16%, but I don't think this is necessarily a reflection on Nvidia. There is probably some reflection on the gap between the Hopper build out and those data centers and the highly anticipated Blackwell, which really probably don't get full production until later this year. And it's also a reflection of Supermicro basically being a shady company that not a lot of people actually want to deal with. Now, moving on to Google, start of the week at 160. This one drifting higher by over 2%. This again, as we talked about with Apple, they're reaching an AI deal potentially with them to bring Gemini to Apple. One of the world's greatest software companies is having to partner with multiple software companies on AI. Tim Cook needs to go, folks. Now, Google's got their own legal problems like Apple. This one not related to the one that is causing them or potentially causing them to divest some pieces of their business, including the Chrome browser. This one goes at the heart of Google's ad business, including its ad exchange and its publisher and server business. The DOJ is looking to separate the two companies, and tell you what, both Google and Apple likely to have legal overheads for the rest of the year. Moving on to Microsoft, start of the week at 390 and shares rocketing up 11% in a week. Folks, this is an $11 trillion company, up 11% in a week to finish the week at 435, a stone's throw from the 52-week highs at 468. This is after the company announced earnings, which were spectacular, growing 13% after being in business for like 30, 40, 50 years, however long it's been with Microsoft. It's just incredible. $70 billion of revenue. That beat expectations. Even better than that, they gave us guidance for the upcoming quarter between 73.15 up to $74.2 billion. Wall Street estimates was for $72 billion. This silencing doubters and proving the AI trade is not only here, but it's not only getting stronger, it's heating up. And I believe that's likely a trend headed into the rest of the year. The company is preparing to host xAI's Grok model as Microsoft is trying to separate a little bit from OpenAI, allow that company to kind of do its own thing. Microsoft also not wanting direct exposure or all its eggs in one basket. I think both companies, ChatGPT and Microsoft, they don't want their eggs in each other's basket, where that's the only AI model that Microsoft relies on, and OpenAI doesn't want to rely strictly on Microsoft from a data center perspective. So the two companies, I think, are diversifying in a smart way. Part of that is getting other AI models onto the Azure server. Moving on to Tesla, start of the week at 289, up and down, choppy day for Tesla. Shares roughly flat, but year to date still down 28%. This is after a rumored report that was quickly shot down that the board of directors was reportedly searching for a new CEO after Elon Musk, in many people's opinion, has damaged the brand by connecting himself very closely with not only Donald Trump, but the government and the Department of Government Efficiency. That brings up questions: can Tesla recover its brand reputation and improve it with Elon Musk reducing his time over at Doge? This is not going to be something that happens overnight. This is likely something that will take about a year or two. I will say one of Elon Musk's weaknesses is actually branding. Believe it or not, even though his personal brand and Tesla are absolutely off the charts in that category, they don't do any kind of paid marketing. They don't do any type of endorsements. They don't do any type of outreach. And I believe that is what's needed going forward with Tesla. Elon Musk is always going to be associated with this brand, but one way to help it recover is to not have it strictly rely on Elon Musk. Very similar to how a Nike attaches itself to athletes, or other brands like Rolex attach itself to athletes. That is one way Tesla can get out of it. I'm not saying that's the only way, but that is one way. But the company has been opposed to advertising, and they certainly will be opposed to endorsements. So in my opinion, the brand reputations with Tesla will likely stay on the brand for the time being, and it'll actually take it longer to recover than, like, maybe say a Bud Light, which a year or two ago had terrible brand damage. And I think if you look at the data today, Bud Light is like the number one selling domestic. It's like the brand completely got over any kind of damage it has. So these things are recoverable. These things are absolutely something you can come back from. But the way Bud Light did it is through advertising with Peyton Manning and Post Malone and other people in its commercials. That was a great strategy. They executed on it and it worked. Tesla needs that. If they don't do that, this will continue to overhang on the brand. Many believe that the robotaxi service, which I saw operating, not Teslas, I saw Waymo's down in Southern California, could get to 100,000 vehicles this year. There is some confusion by some investors thinking these will be the cybercabs, the ones that have the flip-up doors, no steering wheel. Tesla can scale up to 100,000 vehicles because they are going to use existing Model Ys, not only ones that are already made, but any ones that roll off the factory floor and that aren't selling because of brand damage and other types of things. Well, they can go out in this robo-taxi fleet. Obviously, that's expensive from Tesla's perspective, as they are not realizing the price of those, and they'll have to capitalize that over giving rides, but it's certainly one thing that Tesla could do. Now, moving over to the technical segment of the show. S&P 500 did a full back test to the bottom of the channel. Here we are back in what I would call kind of the middle of the channel. You're looking for this one to get rejected here. Rejected, retest the lows that we made back in April. Could present a buying opportunity. Further pushes higher, in my opinion, creates selling opportunities. Take some of those short-term profits. What was interesting about this large drop that we had in the first part of the year, it appears to be largely institutions actually sold, hedge funds. Professional money managers sold all the way down, and who bought the dip was actually retail. Retail is not necessarily quick to sell, especially when things are going well on the way back up. So what we could see is a push all the way higher as money managers chasing performance are going to have to buy this market on the way up. We'll certainly see how that materializes in the month of May. Meta bouncing off a beautiful area here at, we'll call it $500, still butting up against the middle of the channel. The all-time highs are back at $775. So even if you've been late to this rally, there's plenty of upside left if these stocks keep moving. Apple facing a lot of headwinds, but there's clear buying opportunities down here at 190. Amazon has a clear area of resistance. In fact, I'll change this green line to red. This area at 190 was resistance back in 2021, even in 2024. You're looking for a break higher with Amazon, a break higher could move you back to the all-time highs at 241. A break higher and then a back test back to 189 would trigger a buying opportunity. A full-on rejection from 189, that's what I would be hoping for. Rejection at 189 back to the 150s, 160s, that's a buying opportunity as well. Netflix is leading the FAANG stocks. We've talked about this numerous times that this stock chart actually leads FAANG. And so when this one started breaking out, I believed it was a forecast of what was happening with FAANG. Now we're at the top of the channel with Netflix. If this thing breaks down, which I would actually expect, it could mean that FAANG stock rallies, peters out in the middle, come back and retest lows with Netflix. That would be a buying opportunity. Nvidia has been range bound for over a year now. Hard support resistance here at 113. You're looking for this one to break higher. It doesn't report earnings though until the 28th. So you got several weeks to go with that one. Google, similar position as Apple, south of the middle of the channel. This one can be accumulated. Just understand you've got legal issues hanging over that stock for a very, very, very long period of time. Microsoft putting up a big green candle. Looks like we're destined to retest these areas back up here in the 450s. You are likely to get rejected at those levels. Rejections on Microsoft can absolutely be purchased. And finally, Tesla, if they can start to repair the brand and get those robotaxis on the road, well, you could retest these highs at 505, but this one actually has been trading sideways for a while. And that might be good if you're trying to accumulate shares of Tesla. Folks, that was the FAANG Stock Recap Show for Friday, May 2nd. Check out Equity Empire. We've got analysis. We've got buy ratings. We've got small caps. We've got large caps. Appreciate everybody that has subscribed already. Got a lot more coming over there. In fact, that's where the bulk of my work will be going, all because of your support. So I do appreciate it. Hopefully you have a safe weekend, and we'll see you again soon. Good luck with your investments.